the main types are commercial due diligence, financial due diligence, legal due diligence, technical due diligence, and environmental due diligence. Due diligence reports often give nature of a risk but are not able to quantify it fully. There are various risk mitigation techniques which can be attempted. One is to attempt to renegotiate the terms of the deal. Another might be to buy insurance against a particular type of risk. A third one is dealt with in the completion of the deal, the so-called warranties and indemnities debate, where the seller gives certain undertakings to the buyer with a recognition of financial penalties if those turn out not to be true. Here is an example of the typical output of a strategic due diligence report, a benchmarking of a company against available information about its competitors. In this case, the information is regarding EBITDA margins of food production companies. And we see here, for example, that Nestle has margins of about 25%, whereas Campbell Soup is closer to 20%, whereas a volume own label food producer like Tyson Foods or Dean Foods is sub 10%. The company being considered, Heinz, was making 18% EBITDA margins before its takeover by a Brazilian private equity firm, 3G Partners, also backed by Warren Buffett, and they have subsequently been able to raise margins by 6% of sales. We're now going to consider how private equity funds generate returns for investors, usually measured by the internal rate of return. There are several components of return. We can use the functions in Microsoft Excel equals IRR or equals X IRR to give us an estimated percent per annum return. In this case, it would be 30%. We see here in this proposed deal, the cost of the business will be 5 million. We need a cash outflow to calculate IRR. We'll generate an income from the investment each year over 4 years of 1 million a year. In turn, we expect to exit for an enterprise value of 8 million at the end of the period. There's several workable definitions of internal rate of return. The first one is the theoretically correct one. It is the discount rate at which the net present value of the cash flows of the investment equals 0. An investment may have no IRR, 1 IRR, or could in fact have more than 1 IRR. The second definition is more of an analogy. It's the compound rate of return per annum on an investment, like the APR on a credit card, or more strictly the yield to maturity of a bond. Third definition is one which links the multiple of invested capital to the time the investment is held. We'll see that on the next slide. In this table, on the left-hand side, we have the multiple of money, also called the multiple of invested capital, or MOIC. Across the top, we have the years the investment has been held for. We see, for example, that if we held an investment for 5 years and made 3 times our money, that would give us an IRR before fees of 25% per annum. Conversely, if we get out within 3 years for that investment, that would give us an IRR of 44%. Mid-sized buyout houses are typically aiming for returns in the low 20s, and there is a mantra which is sometimes said, always model 5 years to exit, hope to get out in 3. We can see in this example how much that would increase the IRR by 19% per annum in the case of 3 times your money, and by 11% in the case of twice your money. Venture capital deal structuring. Venture capital PE firms usually invest with no debt leverage, taking a minority stake in the business in which they're investing. The instruments by which they invest are ordinary shares, sometimes called A ordinary shares, preferred ordinaries, or convertible preference shares, all different forms of equity with slightly different rights than the founders may have. Key determinants are the pre and post money valuations which are placed on the business, the impact of share options which gives fully diluted valuations, and what round we're in. Are we in round A, round B, round C, etc. The terms pre and post money valuation can be a bit confusing. In this example, I've made an offer to the target company of 5 million for 40%. So the amount to be raised in the round from myself and other venture capitalists would be 5 million. Our percentage holding in the company post our investment going in is 40%. Therefore, our post-money valuation for the whole business, if 5 million buys you 40%, then 12.5 million would buy you 100%. So our post-money valuation is 12.5 million. To calculate the pre-money valuation, we then subtract the amount of money invested in this round, 5 million, to give us a pre-money valuation for this round of 7.5 million. There are typical investor protections in almost all deals. Liquidation preference means that the VC firm investing in that round gets all of its money back on the sale or liquidation of the business before there are any returns to founders or investors in earlier stage rounds. Anti-dilution means that if there is a subsequent funding round at a lower valuation, the investors in this round have their percentage position protected by being awarded free shares to remove any dilution. Leveraged buyout deal structuring. The fundamental principle of leveraged buyout investing is that financial leverage, debt, can be used to increase the returns for equity investors, sometimes known as OPM or other people's money, where the additional finance provided by debt and other financiers is the OPM. In the example we see here, we've made a £10 million investment at the beginning of year 1 into a business. At the end of year 5, we exit for net proceeds of 25 million. We have therefore achieved a multiple of money or multiple of invested capital of 2.5 times, 25 over 10. Looking at our multiple of money, 25 over 10 or 2.5 times down the left hand side and holding for 5 years, we see this gives us a 20% internal rate of return. We can use leverage to increase our return. In this scenario, we've borrowed 5 million of the 10 million purchase price on an interest-only loan. Our initial investment is thus only 5 million, and our debt is 5 million. At the end, we still exit for 25 million. That's our gross proceeds. We need to repay the 5 million of debt that's still outstanding, so our net proceeds are 20 million. So our multiple of money or multiple of invested capital would be 20, 25 minus 5, divided by 5, our initial equity invested. That's equivalent to 4 times. We see here that a multiple of money of 4 times and a holding period of 5 years gives us an IRR of 32%. We've increased our IRR to equity from 20% in the all equity finance case to 32% in the debt financed case simply by borrowing £5 million worth of money. Unfortunately, adding leverage also increases the downside risk. In this second example, we were only able to sell the business for 6 million, thus losing 80% of our investment, from 5 million of equity down to 1 million. If we'd only invested 10 million of equity out the debt, we would have only lost 40% of our investment, from 10 million down to 6 million. And of course, we'd get nothing if the sale value of the business falls below 5 million. To meet the valuation expectations of a vendor, we're often in quite a competitive situation against other potential buyers of the business. We often find we need to look for ways to increase the IRR of the deal so it's acceptable to the investment committee. One way would be to shorten the holding period. An example action to achieve that might be to identify the future buyer of the business pre-acquisition. Another would be to increase leverage, borrow more money. We'd need to do this by increasing the cash generation of the business, and 2 common ways of doing that are either reducing investment in net working capital, current assets and liabilities, or by cutting capital expenditure, investment in long-term assets. A third way of increasing IRR might be to increase the exit value. That might be achieved either by improving the profitability of the business post-acquisition through cost reductions, or by increasing the exit multiple of profits that a buyer would pay. Businesses are often valued on an enterprise value to EBITDA multiple, and if we can reposition the business in some way and make it more attractive to potential buyers, we may get a higher exit multiple. Sweet, sweat, and private equity equity. Sweat equity is normally the equity awarded to management. With management, we talk about hurt money, which is the amount of the money that management will invest in a deal. Typically, it's 1 to 2 times annual salary, or enough to cause significant pain if it is lost, but not a personal financial disaster. The intention here is to motivate management to work as hard as possible to create value for the other investors, the PE firm. To protect its own investment, PE typically invests in a mixture of ordinary shares and loan stock. Loan stock, or loan notes, are unsecured debt instruments that are lent to the portfolio company with an attached coupon. Often the coupon rate is 6 to 8% per annum, but there are no hard and fast rules. It will be repayable when the private equity firm sells the company. In doing this, the PE fund has given itself a degree of downside protection and possibly an ongoing income from the investment. So in the example here, we see that for the sweat equity, because they're going to sweat for it, management have invested £10 and are given 10 ordinary shares. If the business is sold successfully, they'll make 10 times the upside of the PE fund. However, if the business is sold for less than the original equity value that was placed on it when the investment was made, they'll get nothing. The PE equity, sometimes called the PE strip, which the limited partners will get, will be typically £1 of PE ordinary shares and £9 of loan stock paying some coupon. If the business is sold, they'll get roughly 1 times that value. On the other hand, if the business is sold for less than the value placed on originally, they may get up to £9 back of their £10 investment. Sweet equity is often given to friends and family, for example, an incoming non-executive chairman on the deal. This shares some of the upsides of management, in this example 5 ordinary shares for the £10 investment, but also some of the downside protection of the PE funds. The goal is to align the interests of the sweet equity investors with both management and the funds. Ratchets are a way of further apportioning value in a deal. A typical ratchet might give management a greater percentage of the exit value of the business if certain targets for value or for internal rate of return for the investors are achieved. For example, in this example, 150 million exit value, management has 5%, but if they raise it to a 300 million pound exit value, they would have 12%. 12% of 300 million is 36 million pounds, not bad by anyone's measure. Another example could be based on the timing of exit. This is designed to incentivize management to exit more quickly. The main problem with this ratchet is that it may be asking management to do something they can't control, and it could also make them excessively short-termist in their management of the business. Routes to exit vary, and a good investment plan is not prescriptive. Data we have from the British Venture Capital Association in 2012 shows that about 4% of deals were exited via an IPO, about 11% of invested capital via the repayment of loan stock or preference shares, about 18% via the sale of shares post the IPO, i.e. when the company was fully listed, about 18% by a secondary buyout, that is to sale to another private equity firm. So the portfolio of one private equity firm sells it to the portfolio of another private equity firm. About 4% were sold to a financial institution. In about 1% of cases, management was able to buy the business back from the PE backers. About 35% were sold to competitors for the business within the same or similar industries. About 4% were written off. Conclusion. Private equity is now a major financial asset class and is likely to keep growing.